It happened. Silver just crossed $100 in Shanghai, not on some random exchange, not in some illiquid after-hours session. On the Shanghai Futures Exchange, the biggest metals exchange in Asia, silver opened up nearly 13% in a single session, trading at 22,634 yuan per kilo, which converts to over $100 per ounce. I'll say that again. Silver is trading above $100 per ounce in Shanghai right now. And if you watched my video last night, you know I said this exact thing was going to happen. I said if Shanghai opened above $95, I'd make a video immediately. It didn't just open above $95, it blew through $100, like it wasn't even there. I was sitting at my desk, refreshing the chart every 30 seconds waiting for the open. When it printed above $100, I pushed my chair back and just stared. Months of data, tracking COMEX flows, recycler prices in China, watching every drain and every spike. And this morning erased every doubt I had. Shanghai was closed for 7 straight days due to Chinese New Year. During that week, international silver climbed from around $80 to $88. Scrap prices inside China rose toward $96. Trade tensions escalated. COMEX inventories continued to decline, and global markets stayed active while Chinese traders were forced to sit on the sideline. They watched the entire move without being able to participate. When the exchange finally reopened, that suppressed demand didn't ease in slowly. It exploded into the market at once. The result was a 13% surge in a single session. That kind of move is not normal volatility. It reflects compressed buying pressure being released all at once after a forced pause. Hey, James here, this is Noble Metallist. If you are new to the channel, press the subscribe button. I called this exact move last night. I've been calling this rally for months, and what I'm about to show you in this video is the kind of data that will change how you see silver forever. I'm serious. This video needs to reach as many people as possible. So, please help me blow this up. This is where confusion starts. International spot silver is still trading in the high dollar ADS, while Shanghai is pricing silver above $100. Both numbers are technically correct because they represent different markets. The key difference is the premium. Shanghai is trading roughly 14% above international spot, and that premium is the most important signal in the market right now. When China pays that much above global pricing, it indicates strong domestic physical demand combined with supply restrictions. With export limits in place, domestic prices must rise in order to attract available metal. A premium of this size does not happen casually. It suggests tight physical conditions. The mechanics are simple. Metal flows toward the highest bidder. If Shanghai is paying $102 while London pays $88, the economic incentive favors shipping metal east. That naturally tightens availability in London and New York. Industry participants often say that once premiums exceed 8–10%, physical rerouting begins. At 14%, the pull becomes even stronger. Even my aggressive expectation was a high -$90s open, not a print above $100. The speed of this move is what stands out. Rapid price expansion in commodities often signals imbalance beneath the surface, rather than random volatility. At the same time, managed money long positions on COMEX sit near 12,000 contracts, the lowest level in roughly 2 decades. In 2006, when silver traded near $11, there were more speculative longs than there are today, with silver near $88 internationally. That tells us something important. This rally has not been fueled by hedge fund momentum. In 2011, during the run toward $49, positioning climbed close to 100,000 contracts. If current positioning expands from 12,000 to even 50,000, that represents tens of thousands of new contracts entering the market. The participation base is still relatively light. An increase of 38,000 contracts would equal roughly 190 million ounces of additional exposure. That scale matters when inventories are trending lower. March open interest remains elevated as first notice day approaches. Even if the majority of contracts roll forward, a small percentage choosing delivery would represent meaningful physical demand. Meanwhile, SLV borrow data suggests short positioning is not aggressively extended at the moment, which could indicate some shorts have already reduced exposure rather than pressing downside bets. Warehouse reports have shown multi-million ounce outflows in recent sessions. When registered inventory declines, available backing for futures contracts becomes tighter. While total inventory still appears large in absolute terms, markets tend to focus more on direction than size. If open interest remains elevated while registered supply trends downward, sensitivity increases. Combine that with a 14% Shanghai premium, and the narrative of tightening conditions becomes stronger. It's the combination of these factors that drives attention. The $14 spread between Shanghai and international pricing creates a clear theoretical arbitrage opportunity. In practice, capital controls, regulatory requirements, logistics, and timing complicate execution. However, the existence of the spread changes behavior regardless of whether large-scale arbitrage occurs. Futures holders seeing higher pricing abroad may reconsider rolling forward versus standing for delivery. Even limited adjustments can influence expectations, and markets often move on expectations before flows fully materialize. If international spot also breaks above $100, media coverage would likely increase significantly. Commodity rallies often shift into a second phase once mainstream headlines amplify momentum. Silver has historically been under-owned compared to equities and digital assets. With positioning still relatively light, there is room for increased speculative and retail participation if sentiment changes. When participation expands, price acceleration often follows because new capital enters a market that is not structurally large. On the industrial side, demand remains relatively stable. Solar manufacturing, electronics, and various advanced technologies rely heavily on silver's conductive properties. Short-term substitution is limited. Higher prices increase costs, but demand does not disappear immediately. On the supply side, mining output cannot expand overnight. New projects require years of development and permitting. Existing mines are often operating near capacity. That lag between price signals and supply response can extend periods of tightness. Risks must still be acknowledged. Margin increases on futures. Exchanges can trigger forced liquidation. Geopolitical developments or macroeconomic slowdowns can pressure commodities broadly. Silver is historically volatile. The recent drop from $117 to $77 shows how quickly sentiment can shift. Even strong trends experience sharp corrections. Price strength does not eliminate volatility. It often increases it. The spread between Shanghai and international pricing will be crucial in the coming days. If the gap remains wide and persistent, upward convergence becomes more likely. If it narrows quickly, the divergence may prove temporary. Monitoring delivery data, ETF flows, positioning shifts, and warehouse reports will provide clearer signals. Markets tend to confirm or reject extreme price differentials over time. Historically, silver rallies accelerate when positioning transitions from quiet accumulation to active speculation. Moving from 12,000 contracts toward materially higher levels would signal that transition. In previous cycles, that shift produced the fastest price moves as new participation compounded existing momentum. The absence of heavy speculative positioning today suggests capacity for expansion if sentiment turns decisively bullish. Shanghai printing above $100 is a significant signal from a major physical marketplace. International confirmation has not yet fully aligned, but the divergence itself is notable. The coming weeks will determine whether this represents the beginning of broader repricing or a temporary imbalance. Delivery behavior, speculative participation, and premium sustainability will shape the outcome. The market now appears to be at a critical inflection point. I'm not here to build a cult of followers. I'm here to build a community of thinkers. At Noble Metals, I provide the raw data, but I want you to bring the hard questions. We live in an era where debt is sold as wealth and clicks are sold as value. Don't just take my word for it. I encourage you to be a skeptic. Check my sources, challenge the mainstream narrative, and verify every claim I make. Because at the end of the day, a truth you've discovered for yourself is far more valuable than any hype or financial trend. Real gold is rare, but real truth is rare. Let's find it together. This is Noble Metals. I'll see you in the next one. Stay skeptical, stay informed.